Happy Saturday. This week, President Trump announced a new chairman of the Federal Reserve. Apple's earnings beat comes with a caveat. Massive layoffs are betraying a positive market, and silver buyers suffer. Welcome to the Financial Roundup.
A major power shift is coming to the Eccles building as President Trump officially taps Kevin Warsh to lead the Federal Reserve, marking a triumphant return for the former governor, who was once the youngest person ever to sit on the Fed board. Warsh, a 55-year-old Wall Street veteran and Stanford scholar, has been angling for this job for years, and it looks like his time has finally arrived. What does this mean for the markets right now? In the immediate term, this nomination signals a move towards a more dovish or growth-oriented Federal Reserve. Unlike Chair Jerome Powell, who often clashed with the White House over rate hikes, Warsh has recently echoed the president's calls for lower interest rates. The market's initial reaction has been one of stabilization for the dollar, but there is clear regime change premium being priced in. Investors see Warsh as a bridge between Wall Street and the White House. He's someone who coordinated the Fed's response during the 2008 financial crisis and has deep ties to the banking sector. His alignment with the administration's tariff policies and desire for lower rates suggests that the Fed may soon prioritize domestic economic expansion over strict inflation targeting. Looking to the future, the big question is the long-term independence of the central bank. While Warsh was once a hawk who warned against inflation and bond buying, his recent shift towards Trump's perspective suggests a Fed that will be much more integrated with executive branch goals. For investors, this could lead to a sugar high of lower rates and cheaper capital in the short term, but it risks reigniting inflation down the road. If Warsh successfully narrows the Fed's mandate as he has proposed, we could see a leaner, more focused central bank, but one that is also more susceptible to political cycles. As we move into the second half of 2026, the market will be watching to see if Warsh's Fed can maintain price stability while keeping the White House happy.
Thursday, the tech world held its breath as Apple released its Q1 2026 earnings report. Coming off a year of massive speculation regarding the Apple Intelligence rollout and the hardware refresh cycle, the numbers are finally in, and it's a mixed bag. Apple reported a revenue beat, posting $124.8 billion for the quarter. This was largely due to an increase in iPhone sales. Despite global economic headwinds and fluctuating exchange rates, the iPhone 17 Pro series seems to have spurred a lot of people to upgrade. Analysts are pointing to the deeper integration of AI features as the primary driver for consumers finally trading in their older models. However, the real story for long-term investors remains in the services division. Revenue here hit a record high, growing 14% year over year. This isn't just App Store fees anymore. We are seeing a significant shift of the Apple ecosystem towards software as a service. From expanded iCloud Plus tiers to the new premium AI subscription models, Apple is successfully extracting more value from its existing 2 billion plus active device base. The shift toward recurring revenue is providing a massive cushion for their gross margins, which remained robust at over 45%. So, what does that mean for the broader market? First, it confirms that the consumers at the high end of the market remain resilient. Even with interest rates stabilizing at higher levels than the previous decade, luxury and high-end tech demand hasn't cratered. Second, Apple's performance sets the tone for the rest of big tech. If Apple can maintain margins while investing billions into neural processing units and data centers, it signals to the market that the AI return on investment is finally beginning to materialize in tangible consumer sales, not just enterprise hype. The stock market seemed pretty enthusiastic about it, as the stock price complemented a green day with an additional 1% gain following the announcement in the evening. However, institutional investors aren't quite convinced. In the last few months, Apple's AI investments have consistently led to disappointments. A recent press release confirmed that the Apple Intelligence is effectively dead, and that they're dropping OpenAI integration in favor of Gemini. Google, the parent of Gemini, is a significant competitor for nearly all of Apple's services. Android competes with iPhone. Google's productivity and cloud suite rivals Apple's. Both even have their own TV platforms. Overall, the lack of institutional confidence signals declining faith in AI and a growing annoyance with investment in that space. Many analysts even say that AI is a bubble, and Apple shows that it might be about to pop. Overall, the guidance for Q2 remains cautiously optimistic. Apple management hinted at further expansion into wearable technologies and more aggressive stock buybacks. For the broader market, Apple's success provides a fight to quality signal. When the largest company in the world changes strategies, the confidence of the market changes, and companies hedge their bets for the future. Morning Brew Markets highlights one of the most persistent paradoxes in modern finance. When layoffs happen, stock prices rise. The report published this week highlights a trend that has dominated the first quarter of the year. Despite a cooling labor market, major indices are hovering near all-time highs. Investors no longer view layoffs as a sign of distress, but rather as a prerequisite for the efficiency trade. With new systems and technology, companies can do more with less, and investors love the savings. Funnily enough, this concept has been around since even before the Industrial Revolution. Studies show that innovation leads to layoffs for those who are replaced, but there are always new types of jobs created in these new industries. Capitalism rewards progress. From an economics perspective, this is the aggressive pursuit of operating leverage. When a firm, particularly in the tech or financial services sectors, announces a 10% reduction in headcount, the immediate impact is a decrease in fixed labor costs. When revenues slow, the easiest way to protect earnings per share is to slash expenses. Markets are forward-looking. When a CEO announces restructuring, the market prices in the expanded margins of the next 4 quarters today. This is why we often see a stock price jump 3 to 5% on the very day 1,000 employees lose their jobs. It's a cold, mathematical preference for capital efficiency over social stability. But there is a dichotomy at play here. While it might be rational for one firm to cut staff to boost its stock price, if every firm does it, we face a macroeconomic crisis. Mass layoffs reduce the aggregate disposable income of the consumer base. Consumers, of course, account for roughly 70% of US GDP through their spending. Widespread efficiency trades eventually erode the very demand that drives revenue. It's like a corporate tug of war between short-term margin and the long-term demand destruction. But investor psychology hasn't always favored layoffs. In the early 2020s, expansion signaled growth and prosperity. A layoff signaled failure. In 2026, layoffs instead signal quality. Investors are rewarding disciplined management teams that prioritize liquid assets and low expenses over headcount numbers. But it's not all sunshine, of course. If the stock market continues to rise while the labor market softens, the already large wealth gap gets wider. Those who own the equities benefit from cost cutting, while those who rely on wages get burned. This creates market volatility and eventually brings regulatory or political intervention.
Now, we have to talk about an absolute bloodbath in the commodities market. While most eyes were on the Fed nomination, the precious metals market was essentially falling off of a cliff. On Friday, silver prices suffered a staggering 31% crash, marking its worst single day since the Hunt brothers' infamous corner on the market back in 1980. Gold wasn't spared either, seeing its biggest one-day dollar decline on record as the gravity-defying rally we've seen for months finally hit a wall. What triggered this sudden carnage? According to Wall Street, it came down to the Warsh effect. For months, investors have been piling into gold and silver as a hedge against a weakening dollar and potential inflation, a strategy known on the street as debasement trade. However, the news of Kevin Warsh's nomination as Fed chair acted like a needle to a balloon. Because Warsh is viewed as a hawk who prioritizes fighting inflation, his pick immediately sent the dollar to its strongest day in months. As the dollar surged, the justification for holding precious metals vanished almost instantly. The fallout was felt across the board, with mining stocks taking a heavy hit and helping to drag down the S&P 500 and the Nasdaq. Looking forward, there are 2 ways to view this violent sell-off. For industrial players like solar panel manufacturers and auto parts makers, this might actually be a welcome relief. Analysts suggest that this could be a much needed reset after skyrocketing metal costs were beginning to pinch production margins. However, the sheer speed of this drop has many veterans worried about the underlying health of the market. With precious metals currently swinging with the volatility of meme stocks, there is a clear lack of liquidity that could lead to more mystery-driven swings in the future. As we head deeper into 2026, the big question for your portfolio is whether this was a one-time correction or the start of a longer-term shift back toward traditional currency stability.
Thanks for watching this week's Finance Roundup. Please like the video and subscribe to the channel. We'll meet you back here on Saturday for the next episode. Have a great weekend.